Hi everyone. Today, let's talk about options basics. This will be part of a series where I talk about everything involving the technical aspect of options in quite a bit of detail. First, I will go over the basics of trading options, including what a put and call are, buying and selling options, and how exactly they work in terms of a contract. Then I will go over some real world examples using the ticker CCL or Carnival Cruise. If you like trading stocks and options and making money, definitely like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So, what are options? Options are contracts that allow the option holder, which is the buyer of the options contract, to either buy a stock at a certain price if it is a call option, or sell a stock if it is a put option. That contract gives them the right, not the obligation, and for that option buyer to be able to purchase that contract, there must be an option seller. And the seller of the option contract is obligated to buy or sell to the option holder if the option holder decides to execute the options contract. These contracts do expire at the specified date of the options contract. So when the transaction takes place, the buyer and the seller must agree to a certain price and a certain amount of time for that options contract to exist. And the further out in time the contract goes, the more expensive the contract, because the option seller is taking on more risk with regards to how long the contract is good for. Also, if a stock is more volatile, the price of that option contract will be more expensive the closer to the actual stock price you get. If that's a little bit confusing, I will definitely explain it further when we get to the examples of real life options contracts. Moving on, options are a derivative market, meaning if you trade options, you don't specifically have to trade the stock. You can always close out the options contract prior to expiration, all the way up to the minute of expiration, and never actually have to purchase or sell the stock. Just for reference, other derivatives include futures, forwards, swaps, and mortgage-backed securities. Since call and put options are derivatives of the underlying stock, the price of the option is intrinsically linked to the actual stock price, because if the options contract is executed, you will have to either purchase or sell the underlying stock based on the terms of the contract. If it wasn't for that underlying stock, the option contract itself would not have any value, but because it can be converted into stock, option contracts do have that actual value. Moving on to the example here, this is Carnival Cruise, which is trading at $20.80 currently. This is the put side, this is the call side. Remember, the put side is giving you the option to sell a stock at a given price, and the call side is the right to purchase a stock at a given price. So for example, if you wanted to buy Carnival Cruise at $15 a share, you would pay $6.40 per share for that right. So effectively, you would be paying $21.40 if you include the $15 per share, which is above the current stock price of $20.80. But it does allow you to control 100 shares for only $640 instead of buying 100 shares of the stock at $20.80, which would be over $2,000. So it allows you to control 100 shares for roughly around a fourth the total capital. Similarly, on the put side, if I wanted to sell the stock at $25 per share, I would pay $5.20 to do that, which means I would effectively be selling the stock at $19.80. And the current market price, as I mentioned, is $20.80. So I would need the stock to move down at least $1 before I would start to make money. As an option seller, I sell options that are below the current strike, hoping that the stock rallies and that my option contract expires worthless. And I will explain what that means a little bit more on the next graph. Other things to mention here are the probability of profit percentage, probability of 50% profit, the deltas, and the thetas. Delta is the equivalent position of the option position you have here. So when it says 23 delta, it means you're effectively long 23 shares of the stock. Theta is the value the option contract will lose every single day. In this case, it's $1.69. My max profit is $101 because the option contract is valued at $1.01 per share. They give you a max loss because this is the value of the total stock purchase you would have to make. And then they hold some capital in reserve to ensure that you can pay for any losses. Most brokers require you to put up more money than this, but for this specific, it would be $177. So the option contract that we're going to look at is $17.50. And that goes out to 54 days from now, which is February 19th. And for that, I would receive $101, which is $1.01 per share. So looking at that example, you can see $17.50 on the put side, expiration February 19th, price $1.01 for that contract. So my break even is down here at $16.49 at expiration. And for any stock price above $17.50 at expiration, the contract will be worthless and I will receive the full $100.01. Now to the downside, my risk is in theory infinite, but this is true whether you hold the options contract or the stock itself. If I were to hold 100 shares of Carnival Cruise, then I would have this same risk profile to the downside. If the stock went to zero, I would lose 100% of my holding, and that is the exact same risk profile that you have here for the options contract. The only difference here is that your profit to the upside is limited. I can only make $1.01 per share, whereas if you were to own the stock, in theory, your profit to the upside would also be unlimited. But if you were to purchase the stock outright, you have basically a 50-50 chance that that stock will go up or down at any given point. Whereas for me to be purchasing the stock with an effective price at $16.49, my probability of profit is over that 75%. And if I'm willing to accept 50% profit, there's an 85% chance that I will receive that 50 cents per share or $50. So the trade here is I'm accepting a lower potential profit for a higher probability of profit. And if I just wanted to own the stock, but I didn't want to buy Carnival Cruise at $20.80, and I think $16.49 is a better stock price, then this is a great contract because I'm essentially getting paid to wait for the stock price to go down to that point. And if it never comes down to this point, then I get to keep the $1 per share. And if it does come down to this point or even below, at least I'm buying the stock down here at $16.49 instead of buying the stock all the way up here at $20.80. And that's really the power of selling puts. Moving back to the article here, let's go over buying calls, buying puts, and selling puts. They break down some basics here. So buying stock puts you in a long position. Similarly, buying a call option gives you a long position. And short selling a stock gives you a short position, or selling a naked call or an uncovered call gives you a short position. The inverse is true for puts. So buying a put option gives you a short position on the underlying stock, and selling a naked put gives you a long position. So the bottom line is if you're buying a call or selling a put, you want the stock price to go up. And if you are buying a put or selling a call, you want the stock price to go down. People who buy options are called holders, and people who sell options are the call writers. Just a little bit of terminology to help you understand. And the call holder or put holder are not obligated to buy or sell anything. They have the choice to exercise their right, which limits their risk to the total amount of premium spent. So looking at an example here, if I wanted to buy the $17.50 call option, I would pay $4.45 per share or $445. And looking at the graph here, you can see how that profit and loss graph is laid out. So you can see here the $17.50 call, and I paid $4.45 for it. And it's right here at $17.50. And I need the stock to rally all the way to $21.92 before I start making a profit at expiration, which is just the sum of that $17.50 plus $4.45. But if I zoom out here, you can see the theoretical upside is infinite. As the stock rallies, I will make $1 every time the stock goes up $1. Whereas if the stock goes down and expires below $17.50, my max loss here is the full $445 that I spent to purchase the options contract. Whereas if I was holding the long stock, I would lose $1 every time the stock went down. So why use options contracts over just purchasing stock? If you wanted to speculate whether the stock price will go up or down, but not put too much money into it, you can buy cheap options contracts, which reduce your total risk versus buying the stock outright. Or if you wanted to hedge your position, you can do so with options. So if you do own long stock, you could purchase a put option, which would gain value as the stock price goes down, and your long stock would lose value as the stock goes down. And in theory, you wouldn't lose any money whether the stock goes up or down, as long as you own that put option. Similarly, if you are a short stock, you could buy a call option. The short stock position would lose value as the stock went up, and the call option would gain value as the stock went up. Therefore, you in theory wouldn't lose any money regardless of the direction that the stock went. Next up is options expiration and liquidity. So options do expire. If the stock does not move at the specified date of the option contract, the contract will no longer be valid, and any money spent on that option contract will be worth exactly what the option would be worth when it's converted to stock. Meaning that if you purchased an out-of-the-money call option and the stock price goes down, that call option is now going to be worthless. And similarly, if you buy an out-of-the-money put option and the stock price goes up, that option's contract will now be worthless. You can also combine options into things called spreads that allow you to assume similar profits without assuming quite as much risk as selling the option naked, like the example we looked at with Carnival Cruise. So let's take a look at an example of that. So looking at what's called a put spread here, I'm still selling the $17.50 option, but now I'm buying the $12.50 put for 21 cents per share. And since I'm selling an option contract for $1.01 and I'm purchasing a contract for 21 cents, my effective credit here is 80 cents per share or $80. And looking at the curve here, you can see now my total max loss is now capped at $419. That's because I received 80 cents for this put credit spread. And you can see that here, total max profit at $81. But my max loss now is only $419 versus max loss of the total stock price if the stock were to go to zero. Another way to think of it here is I'm paying around 20 cents for this insurance policy, which is reducing my max profit, but is significantly capping my max loss. And a situation where this would be a good options trade is if I didn't think that Carnival Cruise was a great investment right now, but I wanted to speculate on the stock to where I didn't have a total loss potential to the downside, but I still was thinking about buying the stock at $17.50. This would be a good way to dip my toes in the water without assuming all of the risk associated with selling the contract without this protection. There are many other ways to trade options, including butterflies, iron condors, ratio spreads, zebras, jade lizards, many other different options contract strategies. But that's not the purpose of this video. Understanding everything that I said in this video will help you get started trading options. And everything in this video is essential for fully understanding an options position before fully getting started. Let me know down in the comments section if you have any questions or if there's anything I missed in this options basics video. I will continue this series going over more complex strategies and understanding some of the risks associated with different time frames of options. Definitely like and subscribe if you got any value out of this video. If you are not a beginner and you want to take a look at my options positions, I do a portfolio overview every 2 weeks, and you can see the different options that I'm trading. Of course, this is not financial advice. This is all for entertainment purposes, and have a great day.